Today we're going to look at REITs. This video presentation is going to be an in-depth look and explanation of what REITs are. This is based on REITs in the United States, but most facts in this presentation will apply to the UK also. What is a real estate investment trust REIT and how does it work? A real estate investment trust REIT is a business that owns, operates or finances income producing properties. REITs, which are similar to mutual funds, aggregate the money of many different investors. Individual investors can now profit from real estate investments without having to own, manage or finance any of the properties themselves. Excuse me. Takeaways that are important. A real estate investment trust, REIT, is a corporation that owns, operates or funds assets that generate revenue. REITs provide investors with a consistent income stream but little in the way of capital appreciation. The majority of REITs are traded on the stock exchange, making them extremely liquid, unlike physical real estate investments. Apartment complexes, cell towers, data centres, hotels, medical facilities, offices, retail centres and warehouses are all among forms of real estate that REITs invest in. REIT stands for Real Estate Investment Trust, REIT. REITs and how they work. REITs were created by Congress in 1960 as part of the cigar excise tax extension. The provision permits investors to purchase shares in commercial real estate portfolios which were previously exclusively available to the wealthy and through huge financial intermediaries. Apartment complexes, data centres, healthcare facilities, hotels, infrastructures, fibre cables, cell towers and energy pipelines, office buildings, retail centres, self-storage, timberland and warehouses are examples of properties in a REIT portfolio. What is a real estate investment trust? The majority of REITs operate on a simple business model. The REIT leases space and collects rents on the buildings, then distributes the revenue to shareholders as dividends. Mortgage REITs do not own real estate, instead they finance it. The interest on their investment is how these REITs make money. A corporation must comply with certain provisions of the Internal Revenue Code to qualify as a REIT, IRC. These conditions include predominantly owning long-term income-generating real estate and distributing profits to shareholders. To be classified as a REIT, a corporation must meet the following criteria. At least 75% of total assets should be invested in real estate, cash or US Treasury bonds. Rents, interest on real estate mortgages or real estate sales must account for at least 75% of gross income. Each year, pay a minimum of 90% of taxable income to shareholders in the form of dividends. As a corporation, you must be a taxable entity. A board of directors or trustees will oversee the operation. After the first year of operation, the company should have at least 100 shareholders, have no more than 5 people owning more than 50% of the company's stock. REITs are projected to have around $3.5 trillion in gross assets today, with publicly traded equity REITs accounting for $2.5 trillion. REITs come in a variety of shapes and sizes. REITs are divided into three categories. Equity REITs are companies that invest in real estate. The majority of REITs are equity REITs, which own and operate income-generating properties. Rents are the primary source of revenue, not by reselling properties. Mortgage REITs are a type of real estate investment trust. Mortgage REITs provide money to real estate owners and operators directly or indirectly through the purchase of mortgage-backed securities. The net interest margin, the difference between the income they make on mortgage loans and the cost of funding these loans, is the main source of their profits. Because of this paradigm, they are susceptible to interest rate hikes. REITs that are a mix of stocks and bonds. These REITs combine equity and mortgage REIT investment strategies. REIT type comparison. Equity owns and operates income producing real estate. Mortgage holds mortgages on real property. Hybrid owns properties and holds mortgages. REITs are categorized further based on how their shares are purchased and held. REITs that are publicly traded. Shares of publicly traded REITs are exchanged on a national securities market where private investors can buy and sell them. The Securities and Exchange Commission of the United States regulates them, SEC. Non-traded REITs are REITs that are not traded on stock exchanges. These REITs are also registered with the Securities and Exchange Commission, SEC, although they do not trade on national securities exchanges. As a result, they are less liquid than REITs that are publicly traded. They are nevertheless more stable because they are not affected by market movements. REITs that are owned by individuals. These REITs are not registered with the Securities and Exchange Commission, SEC, and do not trade on national securities markets. Private REITs can only be sold to institutional investors. How to invest in real estate investment trusts. By purchasing shares through a broker, you can invest in publicly listed REITs, mutual funds, and REIT exchange-traded funds, ETFs. A broker or financial advisor that participates in the non-traded REITs offering can sell you shares of the non-traded REIT. A rising number of defined benefit and defined contribution investment plans contain REITs. According to NAREIT, a Washington, D.C. based REIT research organization, an estimated 145 million US individuals own REITs either directly or through their retirement savings and other investment vehicles. REITs are expected to own more than 500,000 separate properties by this year, 2022. The benefits and drawbacks of investing in REITs. REITs can be a valuable addition to an investment portfolio since they pay a consistent annual dividend and have the potential for long-term capital growth. Over the last 20 years, REIT total return has outpaced the S&P 500 index, other indices, and inflation. REITs, like any asset, have their benefits and drawbacks. On the bright side, because most REITs trade on public exchanges, they're simple to buy and sell. which helps to minimise some of the real estate conventional downsides. REITs provide attractive risk-adjusted returns and consistent cash flow. A real estate presence can also be beneficial to a portfolio since it provides diversification and dividend-based income, and the payouts are frequently substantial. Pros: liquidity, diversification, transparency, stable cash flow through dividends, attractive risk-adjusted returns. Cons: low growth, dividends are taxed as regular income, subject to market risk, potential for high management and transaction fees. REIT stands for Real Estate Investment Trust. The term Real Estate Investment Trust refers to a company that invests in real estate. A real estate investment trust REIT is a partnership, corporation, trust or organisation that invests directly in real estate by buying properties or purchasing mortgages. REITs issue stock that trades on stock exchanges and may be bought and sold just like regular stocks. To qualify as a REIT, a corporation must invest at least 75% of its assets in real estate and generate at least 75% of its revenue from the real estate related operations. Is paying dividends a requirement for REITs? REITs must distribute 90% or more of their taxable income to shareholders in the form of dividends, as required by law and IRS regulations. REITs are typically exempt from paying corporation income tax as a result of this. REIT shareholders are taxed on their distribution as if they were conventional dividends. So, this is the presentation giving details of what a REIT is, and if you've managed to get to the end, you should now be very knowledgeable on what a REIT is. This is based on the USA REITs, but much of this applies to the UK. I hope you found this interesting. This is a part of my investing adventure, and there'll be many more videos where we will be looking at particular REITs and how I invest and how I performed. Until next time, I bid you a really successful investing adventure.